What's up, YouTube? It's the Action Figure Grader coming back to you with another video. We're going to use a little bit different format today. As you can see, I've got kind of a simulcast going. And I put together some information that I thought might be interesting to talk about. I didn't really have a script or anything like that. So it's going to be kind of interesting to see how it goes. It may not work. I want to mention that I'm stealing this format. This is not my format. I came up with it. It's from a channel called Comic Book Investing, or Comic Book Investments, excuse me. It's a fairly new channel. It's only like 2 or 3 months old, but he's got like 1,200 subs already. And he's growing like crazy. And the reason why is because it's awesome content. Now, he comes at it a little bit differently than I do. We've talked about this in many collectibles videos in the past. I kind of view collectibles as that. You know, I'm not worried about resale. And I don't view them as kind of asset diversification strategies, as you guys remember in my past videos. It's a little bit different for his channel because he actually is in the industry. He's a comic book dealer. So keep that in mind if you check out his channel, but I highly recommend checking out Comic Book Investments. So I'm using his format because he put together a video recently about inflation. And I have a pretty unique background that I thought might add something to the discussion. I don't want to straight copy anybody. There's no point in that. But I've got some interesting data that I put together here, and my background in finance, which I'll talk about a little bit later on, I guess, I think will lend itself well to this discussion. And the topic of the video today is collectibles and other quote-unquote hard assets and what they mean in a high inflation environment. In my opinion, the U.S., I'm talking about the U.S. and all the data is in the U.S., but I'm sure this applies wherever you live and wherever you're watching this. But in the U.S., we're in a pretty high inflation environment. Prices are skyrocketing on everything, as I'll show you. And I think that the warning signs are there, in my opinion, for an overheated economy. Obviously, you guys see this in the collectibles market. If you're watching my channel, you guys follow collectibles, and everything is up. Everything's really expensive. But it's not just collectibles. It's everything, from real estate to commodities to groceries to gas, everything. So anyway, that's kind of the subject of this video, and I wanted to talk about what the implications are for collectibles going forward, and also just kind of investment strategy. It's a little bit more talking about investment strategy too, because again, that's my background. I'm in real estate for my full-time job, and before that, I used to do investment banking. So I would take companies public on the stock market. I would handle acquisition work. I did that for about 4 years. I was a peon. I was on the very low end of the rung. So I did a lot of the grunt work as it relates to that kind of stuff. And but I worked like 80, 100-hour weeks for 4 years doing this stuff. And so I know the stock market well. I know the acquisitions market well and how the economy kind of interacts. So anyway, so let's get started. I'm kind of doing this together, so I don't know how well the camera is going to sync up with this, but we'll take a look. So first I want to start off with gas prices. So as you can see here, I looked at the last year of gas prices here in the US, and we've had, excuse my voice also, I'm sick, but as you can see, through last year's pandemic and into this fall and winter, prices were relatively flat, if not going down. But as we've kind of pulled out of the transition period, the vaccines have become more readily available. People are returning to normal, quote unquote, doing more travel. Airlines are starting to kind of, get back in full swing. Vacations are being planned, all that kind of stuff. People are going back to actual in-work instead of working from home. And you can see what gas prices have done. They've just gone completely crazy. Now, here in the U.S., we had what's called the Colonial Pipeline hacking that just happened this week. And gosh, it's crazy. Like in North Carolina, 65% of the state cannot get any gasoline at all. In Virginia, it's like 45%. Luckily, where I live in Tennessee, it's like 15 to 20%. But still, there's still some gas stations with no gas. So I think that's a temporary blip, and that's driving prices up a little bit. That's not even shown on this map here. And I've got my cursor here. But as you can see, it's been kind of flat here lately. But, there's been a massive drive up in prices from, let's call it at the beginning of January, probably $2.25 a gallon. And now we're sitting at roughly $3.05. Where I live, it's even higher than that. So prices are way up just on gasoline. Next, I wanted to talk about another commodity. I consider this commodity. Oh, hey, one other quick thing about gasoline. Going back to the pandemic, during the pandemic, there was a negative price on oil futures, meaning that barges full of unprocessed petroleum would have to pay the processors to take it off their hands. That happened during the pandemic. It's a negative price for barrels of oil. And so what happened was, during the pandemic, these oil tankers just sat out in the Gulf. They just sat on their supply until the market corrected, which it did correct fairly quickly, a couple weeks later. But I don't think we'll ever see that again during our lifetimes, where the price of oil was actually negative and you had to pay the processors to take it off your hands. So that's a really interesting fact that happened during the pandemic, and probably one of the more interesting facts that I followed during that time. I had nothing else to do. I'm in real estate. I couldn't show houses. I couldn't sell houses. So during that pandemic, I basically worked out, and I kept up with financial markets. And it was a fascinating time to watch all of the different industries in the U.S. and how they were affected by COVID. And I learned a lot about the economy. But that's one interesting fact. But as you can see, look at the prices. It's just gone crazy for gas. Now, another commodity that I wanted to talk about, since I'm in real estate, is lumber. And as this article points out, the prices of lumber are up 308% since the beginning of the pandemic. Here locally, anecdotally, I can tell you that number is way low. Here in Tennessee, the price of lumber is up 700% since March of last year. There was a short-term blip where you can see here in this map, the Great Recession, blah, blah, blah. But here's the COVID recession right here, where the actual production fell because the factories were closed, right? And as you can see, they've started to dip back, or to increase again. What's interesting is that Great Recession, that's really just tied to the housing market, right? Because that was just a massive fall in housing construction prices. But now we got it back to normal after a brief blip. But this number that is mentioned in this article is way low for me anecdotally. Here in Nashville, like I said, 700% is about the number. And we'll talk more about real estate prices in a second. But this is just another sign that, the market is starting to heat up even more than it probably should be. But anyway, here we go. Now, talking about the housing market. Is the housing market officially overheated everywhere? And how long will it last? This is something that I deal with personally. Prices have gone completely insane. Stuff is selling for 10, 15, 20, 30, 40% above the asking price. And it's because there's so much pent-up demand. There's not enough supply because a lot of people took their houses off the market and during last year. So supply is low. Builders are doing their best to kind of play catch-up. But at least where I live, and pretty much everywhere in the U.S., prices are insane. Everything's selling immediately for above the asking price. Multiple offers, cash offers. It's pretty insane. I've got one client where we've put in 11 offers so far. They've been waiving the inspection, so they're willing to buy the house with no inspection, and they're still losing it. They've lost 11 offers so far, so it's just crazy. Now let's talk about the stock market. This is obviously, pretty well-known facts that you can see what the stock market has done. We had the major dip during the beginning of the pandemic. That was short-lived, obviously, after the Fed announced that they would do any and all means necessary to kind of ease financial markets. And that's a big thing. And as you can see, it very quickly jumped back up, and now we're at, towards all-time highs, at least on the Dow. And the reason I bring this up is because it's just another sign that everything is becoming so overinflated, right? As the broader economy suffers from inflation, stocks are naturally going to go up. And the Fed, which controls the rate at which banks can lend money, they basically have that rate at zero, and they've indicated that they plan to keep it at zero or very near zero for the foreseeable future. And so money is cheap right now. People are being able to borrow money at really cheap rates, and it's trickled down into the stock market, right? Because, corporations can borrow at basically zero or close to it, driving growth. And, that's just one thing that's going on, but there's just been so much pent-up demand too that people are buying again. They're going to Home Depot and they're buying. I'm in the middle of a kitchen renovation, which is why I'm doing this video instead of doing a live stream. I never know when the construction guys are going to show up. So it's really difficult to film videos. But they're not here today. But I'm just a perfect example of that. We're redoing a kitchen this this spring and summer, and people are just spending money on everything, whether it's home renovations or home improvements and things like that, buying new houses, filling it with new furniture, everything else, just from all the excess money that they've had saved up from not spending it on vacations and everything else. So as a result, the stock market is at all-time highs, and the Nasdaq, which is basically a tech, a tech focused index, that's way up too. I mean, look at that. It's up 93% over the last year or so. And that's important because, with Zoom and, people having to do everything telephonically and over the web from being locked at home and not being able to go to the office, that's been a big driver. But the other thing I want to point out is that the Nasdaq is basically 20% of the Nasdaq's value is tied to like 5 different stocks. And I don't know them all off the top of my head, but I know Google's on there, Amazon's on there, Facebook. Chris will know the other ones, Chris W. from my live streams, but there's like 4 or 5 different companies that basically make up 25% of the value of the tech Nasdaq Composite. And so it's largely driven by those 5 companies, but nevertheless, I mean, you can see a 93% return on your money if you had invested a year ago, which was towards the bottom, right, during the pandemic. So everything is frothy. And conversely, as I mentioned, the Fed is keeping rates for borrowing, for banks to borrow from the government, very low. And the downside is that if you have cash right now cash is considered a hard asset, I suppose. But what I'm trying to argue in this video is that with a high inflation environment, your cash is becoming worth less and less sitting in the bank right now than it ever has before, because you're not getting any return on it. And if you look at these returns over the last, from 1984 to 2021, these are the average returns. Now, these high returns you don't want either, because that means you're in a really high inflation environment. But right now we're in a pretty high inflation environment, but we're still not getting those returns yet. And so I don't know if it's because we're at the beginning of a high inflation environment, or if it's because this high inflation phenomenon that we're experiencing, at least in the US, is temporary because of people getting back to normal activities after the pandemic. And if it's temporary, then these rates will probably stay low. If these inflationary kind of signs that I'm seeing, at least, and other people are seeing on their grocery bills, then those rates in theory should go up, right? To get back to kind of where they were during higher inflation time periods during the US. During the 80s, everything was crazy expensive. And inflation was going out of control. We had the S&L crisis. Mortgage rates were like 20% back then. Gas prices were through the roof. So we're starting to see the early warning signs of that, though, because we've had so much hike in prices overall for not only commodities like I just showed you, gasoline, groceries, real estate, the stock market, everything is going up, up, up. But you as a personal investor, so to speak, you're not getting any return right now on cash. And so I'm looking at hard assets as things that are not cash for this video. So things like real estate, I guess stocks, even though that's high risk right now, in my opinion. Collectibles, I guess you can consider an asset, but like I've talked about, you got other investment options first before you start looking at collectibles as an investment option. But those items, if you've been collecting over the last year or 2 years, you've seen what at least Star Wars collectibles, just as an example, have done. And I've done videos on this where I've shown even modern vintage collection items have gone up like 400%, sometimes in like 3 months. Some of my Ahsokas, for example. I mean, I bought those last fall for $300. Now there's, $800, $900. It's just crazy. And that's ungraded, So my point is that your return on those types of items, whether it's collectibles or stocks or real estate, has been substantially above just leaving your money sitting in cash. And I think we're going to see that for the foreseeable future. And tying again to what I just showed you about the savings rates, as I mentioned, the Fed has kept rates very low for banks to borrow, and as a result, banks can then lend to individuals looking to get a mortgage for a house, to buy a house, those are at historic lows. They've bumped up a little bit here recently, and I think this is basically tied to monetary policy and the fact that we passed all of these stimulus checks and stimulus bills totaling trillions and trillions of dollars. And I want to mention this too. That this video is not meant to be political. I don't care who you vote for. I don't think you should care who I vote for. And monetary policy is not really tied to who is in office. Monetary policy is controlled by the Fed. The Fed is not controlled by who's in office, whether it's Democrat or Republican here in the U.S. And so this is a broader issue that's talking more about what the Fed is doing in terms of lending practices to banks and their control over inflation. Basically, the Fed's really their only real way to control inflation, once you start seeing it, which we are, is to raise the federal funds rate and the rate at which banks can borrow. And that slows things down a little bit. That kind of puts the halt on the economy a little bit. And I think that they're just worried right now that it's too early to do that because we're just coming out of the pandemic and people are just now kind of poking their head out like, is it safe to come out yet? People are getting vaccinated and people are starting to spend again and go out and travel and all that kind of stuff. So I think it's early, I guess, from their perspective. But as you can see here in this chart, it bumped up a little bit. It's come back down a little bit, but we're still, look at that, essentially 3% for a 30-year mortgage. That's below, well below historic averages over the last, 3 years. It's just the last 3 years. And even at the high points at 4.8%, that's historically low. As I mentioned, I've been in real estate for 17 years, and a typical mortgage rate is anywhere from like 5 to 6% historically, at least short term. And we're at 3%. So we're, basically half that right now. And so people can borrow, and that allows them to buy houses, a bigger house, more house. That drives up prices. And so the real estate market is largely being driven by this and the lack of supply too, of course. So, but that's a good thing, in my opinion, for me, obviously, given I'm in real estate. And I think it's a good thing just for other people because it allows them to have a hard asset. And that's what the point of this video is. During these high inflation time periods, having a hard asset like a house is probably your safest investment because it parks money in something you're living in, and you're not paying rent anymore. You get tax deductions for interest expense. There's a lot of tax benefits for owning a house. So that would be my recommendation. I know I'm biased since I'm in real estate, but if you've got money sitting in the bank and you don't own a house, it's insanity to be renting right now when money is this cheap. If you got enough money, to put a down payment on a house, and I know it's competitive and I know prices are high, but you're getting less than 1% right now in savings versus buying a house right now. And just at a minimum, the tax benefits alone of owning a house, you get to write off your interest expense related to your mortgage. You get to write off your property taxes for the house. All of those are straight write-offs from your taxes each year. And just that alone, your return is more than 1% that you're getting in the bank. So for those of you out there who are watching this, who are maybe younger or just or don't want to buy right now because of the market, your number one hard asset, which is what I'm talking about, to buy in an inflationary environment like this would be a house. That's what I would do. So that's my first piece of advice. And next, I want to talk more about what I kind of hinted at here, and that's kind of the combination of the Fed, and that's outside of the government control. But what is under government control and has been done by both parties, so it's not like I'm trying to be biased here, is all these stimulus bills that have been passing. Trillions and trillions of dollars have been spent over the last so often, since the pandemic started. You can see what has happened to federal debt as a percentage of GDP. And if you go all the way back to even World War II time period, which is 1946, when this data was first started, you can see even during World War II, which is like probably the biggest war in the history of the world, we were still at only about 83, let's call it 83% of GDP was federal debt. And it went down from there during the heyday of the 50s when we had balanced budgets. But something has happened. from around 2010 to now. And this was related to, obviously, the Great Recession that experienced in 2008 and 2009. So federal debt went way up there. And then you compound that with what happened with the pandemic, and you can see what GDP is, or what federal debt is now as a percentage of GDP. That's a terrifying number from my perspective. That's terrifying. That, you know, we're just handing out money left and right. I'm not trying to make an opinion on whether it's necessary or not, but I can tell you that all of these stimulus bills have to be paid for at some point. And we're kicking the can down the road. Politicians on both sides are kicking the can down the road, and our grandkids will be the ones paying all of these bills somehow, be it lower Social Security benefits or retirement benefits or higher tax rates for our grandkids. And so right now we're at 100.2% of GDP, meaning the U.S., the total of the U.S. economy, everything, all the goods and services, everything, all the money that's being spent each year. We're at 100% of that right now, annually, which is terrifying. And then if you look at this chart, this is actual right now. And, you know, this data, again, this is a little bit old, but, you know, we're probably, I don't know when, this is from the Congressional Budget Office, so I guarantee you this is not as up to date as this chart is. But looking at this data, you can see what they're projecting in terms of the federal debt as a percentage of gross domestic product. You can see what they're projecting for down the road in 2030. They're saying 100%. It's going to be more like 120%. So this number is actually low, believe it or not. So this is another terrifying sign that we have major inflation going on. And I know this is, you know, debt is not really inflation. You know, that's not what I'm trying to say. But what I'm trying to say is this is evidence that the government is pumping so much money into the economy, and that's driving prices up for everything. And as it relates to this channel, collectibles. So a lot of people just, you know, I've gotten so many requests over the last so often since I made that pricing bubble video that did really well. I've gotten a lot of questions and a lot of requests for updates. And I thought it would just is important to kind of look at it from a macro perspective. This is, you know, from an economic perspective from the U.S., all of these factors are kind of interplaying with each other, intertwined with each other to create the environment that we're seeing where everything is becoming more expensive. And as the government continues to print money and lend money at low rates, and as they do more and more of the stimulus bills that cost trillions of dollars, all that's doing is devaluing the dollar. And you can see what's happening here. This is over the last year. So about the beginning of the pandemic, here's where we were. And because of all of the money that the U.S. is pumping into the economy and all the stimulus checks, all the checks that they're giving to people, you can see how the value of the U.S. dollar has eroded over the last year. And this is as of current. I mean, that's a terrifying difference right here. I know it doesn't look like much from a grand, but from a percentage basis to go from, let's call it 0.93 to 0.83, that is a massive percentage drop in the value of the dollar versus the euro. And if you look at the British pound, which is an even more robust currency and probably the gold standard, this and the German mark are probably the two gold standards in terms of values right now. You can see what the U.S. dollar has done versus the pound sterling. It's completely terrifying to me to see these kind of drops in just a year. So the market is basically, you know, the global market is basically speaking and saying the U.S. is experiencing massive inflation right now. And as a result, you're going to get less for your U.S. dollar versus other currencies. And, you know, for those of you in the U.S. who maybe don't think about it this way, this is why I'm presenting the data. It's to kind of take a look at how all these factors are affecting prices of collectibles. And this is why, because, you know, when you go to buy a vintage collection, you know, whatever, Star Killer, what used to be $85 is now $240. Well, part of that is because of collecting demand, right? But part of that is because of the erosion of the dollar and the dollar's value. And so the other thing I wanted to point out is, well, what are hard assets? The channel that I just mentioned, you know, he considers Bitcoin and cryptocurrency to be a hard asset. I do not. Okay. For those of you who have money to invest, the last thing I would buy is Bitcoin. And you can see why if you just look at what prices have done. And, look, the stock market has done the same thing, but Bitcoin terrifies me. There's just too many swings in the currency, but these massive increases, maybe they continue to go up. Maybe it drops like a rock again. I mean, you've seen in the past here, back in 2018, where we had some pretty massive changes as well. And, if you had bought around this peak, look at what your money would be worth, down here. It would have gone way down. Well, what if you buy at this peak and it drops back down to kind of historical averages? Let's call the max is about 20,000 Bitcoin per dollar. Right now it's at 49,000. Let's say it gets back down to historical averages of around 15 or 12 to 15. And that's even probably being generous. Right now you're at 49. And to me, there's just too much potential for market manipulation in cryptocurrency. And this goes back also to the video I made about non-fungible tokens and how there's just so much fluctuation. There's so much inflation in prices. What are you really buying? So is Bitcoin here to stay? Is cryptocurrency here to stay? Probably. But I think that for the average Joe like you and I, if you've got $1,000 or $10,000, whatever the number is, whatever your budget is, I think Bitcoin would be my last choice, to be honest with you. You'd be better off buying, like an index fund of stocks, of blue chip stocks, and keeping your money there, or buying the top 5, companies in the Nasdaq, something like that. It's a much safer play than Bitcoin, where there's just so much fluctuation. And you can see what Ether is the other kind of major currency. Ether and Bitcoin are the two big cryptocurrencies. You can see what that's done too. It's a very similar scale, obviously a lower price, but it just, the cryptocurrency market terrifies me. And I don't consider those, in my opinion, hard assets. Collectibles, I guess you can consider a hard asset if you want. It depends on, you got to look at this video depending on what your current situation is. If you're young, you're living at home, and you got $1,000 from your stimulus check or whatever, what do you buy with it? Well, my first choice would probably be stocks. My second choice would be to get something very safe, a safe investment like corporate paper. I don't know. Way down the line would be collectibles, but someone like me who already has real estate, to me, I consider collectibles kind of another form of putting money to work, I guess, but it's all play money, like I mentioned. It's just everyone's budget's different, everyone's current financial situation is different, so you gotta take all my opinions with a grain of salt. But that's really all I had. And as it relates to collectibles, I'm hoping that this kind of information will give you a little insight within the U.S. and globally as to why prices are up. Certainly demand is a big factor for it, because of people just wanting to buy collectibles. But the other big factor that I think that maybe people aren't really looking at closely, and I hope those charts helped you understand, is that because of monetary policy, because of the fact we're coming out of a pandemic, because of pent-up demand, it's driving up prices, and the U.S. dollar's value is eroding. And so that's causing things to become more expensive too. So anyway, if you like this kind of, I don't know if you like this kind of video or not. It's a little different. It's just something I thought would be kind of fun to try. If you liked it though, I'd like to hear from you. A thumbs up, comment below with your thoughts. If you want to see more videos like this, let me know. But I'm in the real estate business, so this is what I'm seeing here in my own job, and in my old job I was in stocks. So those are two big kind of finance related items that I thought I might be able to lend a little bit of additional insight to, and not just copy other folks. So if you like this kind of content though, I'd like to hear from you, and please consider subscribing if you're new. Thanks for watching. Talk to you soon.